that we haven't seen is a cost driver. So it's a unit of measurement or a base for our cost. For example, if I say, if you work for 1 hour, I will pay you $5. So this time, what is the unit or the base for me to spend my money? It's hour. It's on hourly basis. The base is on hourly basis. So if you work for 1 hour, this 1 hour is a unit of measurement, or it's a base. It's a unit, it's an hour, it's a measurement base for you to pay, for me to pay you the money. So cost driver is basically a unit. So this time hour is a unit, which is a cost driver that I pay my money based on that unit. If we see all of this, we have said that tracing cost is very simple. However, allocating cost is difficult because we are assigning an indirect costs. So this time we might use a systematic allocation method or way for indirect material. So what are those methods? We might use a predetermined overhead rate or activity based costing method. These are two methods that we allocate our indirect costs to the cost object. So also, after knowing the product's cost, we might present it using an absorption costing or variable costing method. This is a presentational issue, not determining the cost of the product or allocating the overhead to the product. This is a presentational issue, how we present our product on the income statement. However, this is actually costing, or knowing how much that product worth or how much cost is spent on that product. This is all about that. However, this is more on a presentational issue. We will look at this at the final point. However, let's look at what a predetermined overhead and activity based costing to allocate overhead to the cost objects. How this different method works. In predetermined overhead rates method, cost driver is a basic word. That's why I have presented you at the beginning of this video. Cost driver is a basic word here. At first, why do we need to know the cost of a product? It's simple, because in income statement there is a revenue, and the revenue should be recognized when an expense happens. Without knowing the cost of the product, we cannot know the expense of the product, because as we have said in the previous, expense is an expired portion of cost. So without knowing the cost of the product, we cannot say that an expense is incurred or this much of expense is incurred. So in order to compute revenue with the cost and to calculate the net income, we should know the value of expense. And without knowing the cost of the product, we cannot recognize a cost of goods sold. A cost of goods sold is an expense account, which is a portion, an expired portion of, not expired, but some portion of cost that is transferred to expense, or some part of cost which start to generate revenue. And when it generates revenue, there is that part of cost has been transferred. We can say that that part of cost has been transferred to expense. So in order to calculate expense and to write revenue minus cost is equal to net income, we should know the cost of the product at first. But here we will face a major challenge. Think of this as a year 1, and think of this as a year 2, and think of this as year 3. So we start from year 1, and our financial year ends at year 2, the first financial year, and the second financial year ends with year 3. So on year 3 it's the second financial year. But don't focus on year 3, just focus on the first year. This is from year 1 to year 2, which is one fiscal year. In between we have sales. As we have said previously, we will have a total manufacturing overhead cost, and we will allocate that cost to each product. However, for one company it's very hard to know the total manufacturing overhead cost without reaching the end of the financial year. At the end of the financial year, probably the company might know all of its manufacturing overhead costs that incurred throughout the year. However, at the middle, for example, at this point, as the sales happens, the company might not know any the total amount of manufacturing overhead cost in order to allocate these costs to each cost objects. So if the company waits to until the end of the financial year in order to know the total manufacturing overhead cost to compute an expense or cost of goods sold, the journal entry will not fulfill a matching concept, because here we have a sales, so we will recognize the revenue. However, if there is no cost of goods sold or an expense account, this is by default against the rule of financial accounting, IFRS concept. So how do we know the total amount of manufacturing overhead that we might have at the end of the financial year? At this point, we are at this point, but how do we estimate the total manufacturing overhead of this financial year, the total manufacturing overhead that we will have throughout the year that we know at the end of financial year? At the end of financial year, of course, we will know how much manufacturing overhead cost we have incurred throughout the year. But at this point, when the sales happens, we cannot know the total manufacturing overhead that we might incur throughout the year. So we should have to estimate based on our past experience. So we should estimate the total annual overhead costs when the sale happens.